We'll go to our last paper in this session. So Raphael Schoenle will present how inflation expectations de-anchor, the role of selective memory cues.
We're putting on this paper on the program. This is joint work with Nicola Gennaioli, Marta, Leva, and Andrei Shleifer. So what motivates us in this paper is this fundamental question, right? How people form inflation expectations. There's a delay in all of that, which is also related to my first point, right? We're not the first to ask this question. Conventional belief tends to say, inflation expectations are somewhat sticky. And this can be due to many reasons. So this can be because they depend on a time-discounted slow-moving measure of inflation experiences that we have had. This could be because they're processing costs to form these expectations that lead to inattention and rigidity in belief updating. Clearly, inflation expectations depend on experiences and attributes of respondents. So there's definitely a role for socio-demographic characteristics, as well as for mental models, social network. There's also a role for recent salient prices and price changes of salient goods like groceries and gasoline. And there are many, many other papers from people in this room, obviously, who've contributed to this. So instead, let me just tell you what we do in this paper. So when we look at inflation expectations in the recent period, the data actually show just de-anchoring in 21. There's not a lot of stickiness. Then we present a model of inflation expectations that's based on memory and selective recall, work by my co-authors. And we provide evidence for a state-dependent inflation expectations formation mechanism that is micro-founded in cognitive psychology, whereby basically expectations tend to be rigid when inflation is anchored, but there's also sharp instability during inflation surges. And this instability, moreover, is cohort-specific, and it depends on experiences. And finally, we also present some evidence that whether expectations are elicited as a density forecast or as point forecast can actually change the average expectations, as again, I think a lot of people in the room are aware of. So this evidence that we find is inconsistent, particularly with either a Bayesian model or a simple mechanical experience effects model. So instead, we think this points to a psychologically realistic memory model. But to motivate a little bit more this central state-dependent element in belief formation, let me show you two figures here. So the left panel shows inflation expectations in the US, and the lower envelope orangey line is the youngest age cohort. And the right panel shows the actual experience inflation rates where the same color coding holds. And what you see is there is, as we also learned in a very different approach earlier, there's rapid belief updating during the recent inflation surge. And this is more so there for older cohorts. And you might think this is puzzling, right? Because, new data has less of an impact on an older cohort database. It's just longer. But also, as you see from the right panel, older cohorts actually experience somewhat less of current CPI inflation. So a theory of selective recall, especially for high inflation episodes, can help us understand this. This is a more universal pattern. So here you see the same inflation expectations, the same color coding scheme from the US Michigan survey of consumers. Older cohorts, it's the same message, increase their expectations faster than the younger ones, who then catch up. This is also true in this Bank of England inflation attitude survey. You see exactly in the same color coding, normalized to 1 in the beginning, right? There's a faster increase for the older cohorts, and again, the younger tend to catch up. Look at the ECB consumer expectation survey, again, same color coding, slightly later start of the data set. You again see the same pattern. You can look at the Cabinet Office Consumer Trend Survey from Japan. Again, the same color coding, again, same normalization. You see a similar pattern here of old versus young and dynamics. And then finally, let me give you also some motivation that relates to the density forecast, which is going to be important to a central point about the inconsistency in forecasting that we find. So here you see in these three panels the weight that respondents attached to low, medium, and high inflation during the same episode. And you can see very clearly that the older cohorts in the US shifted weight to higher inflation ranges, while the younger tend to stick to the middle ranges. And there's not much going on in terms of economically meaningful levels on the lowest range at that period. So I'm going to show you a model next, which builds on regularities on selective recall based on cognitive science. Usually what tends to happen in these experiments that are relevant is that they ask, how do we recall what we have experienced? So you might be given, for example, a set of cards. They have words like tape, mole, dad on them, and you do something else, and then you ask to recall what you've just seen, and people recall words like ring, girl, or dad. And what's behind the likelihood of recalling certain cards is really primacy, recency, and similarity. So what are these things? What this figure shows you here. So the left panel shows you the recall probability for these cards depending on the serial position of presentation, while the right-hand side figure shows you the probability of recall depending on cards' word similarity with the cue that you're given. So the retrieval or the probability of recalling from your memory database or what you've shown depends on similarity in a temporal context, so in a U-shaped fashion, as the left panel shows you. That is, there is recency, but also primacy, so things that you see in the beginning and then at the end are most likely to be recalled. But there's also similarity affecting recall probabilities in the semantic context. The similarity between the cue that you're given and then the experiences that you have. So this particular example I gave you, if you're cued with the word parent, you're more likely to recall dad rather than girl. In an inflation context, you're more likely, if you're cued with high inflation, to recall high inflation rather than low inflation. So next, I'm going to show you how to think about these regularities in an economic model of inflation expectations, and then I'm going to present some supporting evidence from US inflation expectations data. The model framework that we build on goes back to my co-author's work, where individuals selectively recall experiences from their memory database when they give them a cue to form inflation expectations. And then the similarity of the experiences with that cue is going to determine the recall probabilities. So the question is really, how do you form these recall probabilities? Well, they're computed based on the database that you hold. In this case, quarterly inflation rates that an individual has experienced since some starting age A. There's some robustness about how you define that. Also, clearly what matters is the cue that you have at the time. So that's the temporal context and the inflation estimation task. Everything is worded, including the event that you consider. So these three features here, for the sake of the model position, they're embedded in these in this PyTE. So in particular, the temporal context is going to imply similarity to recent and early experiences relative to your age. And the task itself implies numerical similarity to current inflation pi-t that you as the decision maker or the respondent sees, and the event you're going to think about, which we think is described by the average experience about that event. So what is then similarity that's going to pin down this recall probability? Well, it's a function that exponentially decays in the divergence of these features. So consider a particular, so this is the equation here, particular experience pi t minus s, given that vector pi t e. Then there are these three terms here. So let me start with the last two. The last two capture numerical similarity. So this particular experience tends to be harder to recall if it's different from your current task, captured in this case by pi t, and the average experienced values in pi t e. And then the strength of all of this is given by this elasticity sigma. And there's some weights to the different ways of measuring this similarity. There's a first term as well. This first term captures this first figure I've shown you, so the primacy and the recency. And it has quadratic, so it gives you this inverse U-shaped divergence. And then this divergence basically pins down your subjective recall probability in a very conventional way. This recall probability of this particular memory is proportional to the negative of that distance. In particular, more frequently experienced inflation rates in your database are going to be more likely to be retrieved, and less similar inflation rates are going to be less likely to be recalled. How do we get to expectations then and probabilities assigned to different ranges? So believe that you are, for example, in a 2 to 4% inflation range, which can be implicitly or explicitly be in the description of this event E, for example, is quite simply the sum of all the relevant recall probabilities embodied by these inflation experiences that fall in the range that I'm asking you about. Point expectations are simply the sum of the subjective recall probabilities times the memories that you have, the pi t minus s. So let me emphasize two things here. So recall and also then the beliefs are state dependent via these pi t and the QQs, but also the beliefs, and this is quite crucial, depend on which event is elicited in this forecast task, how this is described. I think that has really important implications for what we think this is one of the key parts of the paper, for the consistency across different survey elicitations. Okay, I think I should be ready now to give you two testable propositions so that you can take them to the data. They're going to be about the two typical elicitations in surveys, but obviously this is just, everything is just a proof of concept here. You can expand that. So I'm going to talk about point expectations and forecast densities, which basically chop up the real line in different buckets. And I will give you two sets of predictions. First basically says that in both elicitations, beliefs will depend on the temporal and numerical cues interacted with the frequency in the database. And the second emphasizes that there is a systematic inconsistency between the two elicitations here. And particular density-based elicitations will explicitly prompt you to recall some rarely experienced events simply because they force you to do so, and that's going to affect your probability that you weight and thereby the expectations. So the second part is really giving us a new implication for the role of selective memory. It tends to reject any rational model, including Bayesian models in which agents hold consistent beliefs. So let me walk you through this first proposition where we think about elicited point expectations. So when you linearize them around temporal context and numerical similarity, you see basically these three different lines, and they're somewhat intuitive. So the first line just tells you that expectations depend on your average experiences. So in particular, in terms of higher inflation, higher inflation during your lifetime, you're going to have higher inflation expectations in the future. And then there's the second and the third row. So the second row basically tells you here that it's easier for you to recall high inflation if your high inflation experiences are very early on or close to the present, so this primacy and recency. And the third row is the newer part. So you're more likely to recall high inflation if your high inflation expectations are quite similar to the two Qs, right? That's the quadratic term that shows up. So if that becomes very small, then you're going to have a negative sign, you're going to have higher expectations. So this is really the essence of this new element of state-dependent inflation expectations formation, right? You can have very sharp belief changes because of this numerical similarity, even if you're a very slow-moving database. So let me just briefly tell you how we bring this to the data. The data comes from the Michigan Survey of Consumers and the New York Fed SCE. This is monthly data. It's like obviously by the nature of the data sets, it's different periods. It's rotating panels. We take point estimates from both of them and from the New York Fed, the density forecasts. We have a source of inflation data. We started everything at age 16, but this is quite robust. And we have a current inflation queue, and we also allow to control for some kind of common signal, the SPF inflation forecast. How am I doing with time, Damjan? Okay, so the first set of results from the Michigan survey and the New York Fed sort of provide evidence for this first proposition, and they basically confirm all the three memory effects are there. From the first row, just don't look at the details, right? You'll see that this average inflation experience comes out very significant in predicting your point expectation. And then the second row corresponds to the second row in this proposition, that you have a U-shaped temporal context with both primacy and recency. So primacy tends to dominate, but both are there if you compute that. And then the fourth and fifth row basically capture this new element, this numerical similarity, and it's also there. Now, the New York Fed data tell you basically the same story. Strong evidence for all the three memory effects. And I should probably at this point also add that, what do these numbers mean, right? Basically, all the three elements are there, and they sort of have the same economic magnitude if you multiply them with standard deviations in these data sets for these time horizons. Now, perhaps somewhat more interesting for the particular audience today is a medium horizon, expectations over 24 and 36 months. You can run the same regressions and you see the same free memory effects at play, but there is a key difference here from the very short-term inflation expectations, which is that the similarity with mean inflation rate tend to be statistically more important than the similarity with the current rate. So that's this is the one line, the fourth line, where we look at the similarity with respect to the average rather than the fifth line where we have contemporaneous pi t. So this suggests perhaps that long-term or medium-term inflation expectations are shaped by same period experiences. So different cohorts might have different medium targets. I think you can also think about the density forecast, and I have sort of two propositions here. So the first one relates to the odds of one particular event versus another, and that event relative to some frequency of experiencing it, so the nk, and some midpoints ik, basically gives you a very similar set of results relative to the first proposition. The only difference is everything is in relative terms now because you have a base here. So particularly, the first term just tells you that the odds of a particular event increase in their relative frequency, the nj ratio. Then there's a relative temporal context, and there's a relative similarity effect. There's one interesting new element here, which is basically that there's an amplifying effect from the interaction with this relative experience frequency. So if you, for example, go from 2 to 10% inflation, the probability of high inflation should go up for everybody, but obviously it should go up more if you have lived through more of these experiences. Right? This is why this nj over nb multiplies these other terms. That's what this is saying. So I think this really emphasizes the key mechanism due to selective recall. Elicitation of a particular event itself really helps think about this event, stimulating retrieval and the recall probabilities. Don't have that much time, so let me just say, if you take this to the data, based on this beautiful New York Fed density forecast data, basically all the three memory effects pan out, and also in relative terms. You have this basic relative experience effect, the U-shaped relative temporal context, and again, the numerical similarity. So now thinking about the density forecast also leads you to another testable proposition, which emphasizes that really different elicitations are systematically inconsistent. And I think it's something where our paper sort of has gravitated towards over time. So to understand it, think about an elicited point forecast as a weighted density-based average. So your expectation is basically the product of the weights you place on one of these buckets, and then the range J expected value, which itself is computed of the from the subjective probability that you attach to that bucket times that bucket's midpoint or some other measure of the bucket. And the rational model, the weight should all be 1. But this is not true with selective memory, especially if you forget certain ranges when you form point expectations, because you're not reminded of them, right? So in fact, we can show that the point forecasts, so it'll be the third testable proposition, are above the density in a systematic way if your experiences tend to be more similar to high inflation ranges. So your point expectation is equal to your density-based expectation plus this extra term in the second row. So that term exists if the sigma, the strength of similarity, is not 0. So similarity plays a key role in here. And then the sign depends on the difference between the distance of that range to average experience inflation. So that's the DJ. And then the average of all of these, of all the different ranges that you have. That's usually positive if for higher inflation experiences, you are more similar to the average experience distance. And I think the one prediction here is also that if you move into higher inflation, then this term can sort of the two expectations here become a little bit closer, right? Because due to selective recall, you're going to overweight these higher inflation buckets. So the density-based expectation is going to shoot up, but the second term is a little bit more slow-moving because it's attached to some averages. Average experiences. Let me just leave it at that. So I think this really emphasizes this key mechanism of selective recall that introduces a systematic discrepancy across people with different experiences and also based on this changing Q. And obviously it seeks with other findings that, how you present questions and then ask about events affects the probabilities. So what's in the data? Well, in the data, elicited point forecasts tend to exceed the density-based forecast. So this is what this figure shows on the left. You see that the blue has more mass on the right, and this has a mean, also a median that's further to the right than the density-based distribution. And then the right figure shows you the two terms, the point forecast versus the density forecast means. And you see that there's a stunted sensitivity of the point forecast to the density ones, just like this proposition predicts. So there's an intercept at 0, but then this gap also narrows down as you move to higher density forecasts, which tend to occur when inflation is high. So this is exactly confirming this intuition that I just gave you. And I have to move on quickly. So let me give you a little bit more evidence that indeed there is a neglect of deflation and an overweighting of high inflation in the microdata, which speaks to this key mechanism. And I'm going to do this in 2 steps. So first, I'm going to regress household point forecasts on the same household's estimated probability of different ranges. And in a rational model, the coefficient should be close to the midpoints that you attach in this integration. And like I emphasized, under a selective memory model, right, the coefficient might be smaller in magnitude, especially if this range is neglected when you form the point forecast and vice versa. So this gives you this difference. So here I'm just showing you with or without fixed effects sort of these results. And again, don't look at the details. I think what this table tells you is that the pattern of coefficients is consistent with the selective recall model. So you sort of look maybe at the the buckets around 0 and above and below, and you see that you don't really see that the midpoints come out as the estimated coefficients, right? So households actually tend to overweight the high inflation ranges. And at the same time, deflation ranges bear non-significant or even positive coefficients. So that really means if you put more weight on one of these lower buckets, you're actually increasing expected inflation, right? So, but that's also not significant. So clearly, there's some violation of rationality going on, and in this table, I test systematically this proposition that I showed you, regressing point expectations on the density-based mean plus this extra term that accounts for the difference, sort of different configurations, and very clear systematic similarity-based bias emerges here, meaning this extra term plays a significant role. So if you look at the first row, the coefficient on the forecast mean, you see, yeah, sure, the density-based mean has a coefficient that goes up once you control properly for the second term. And then there's also a positive sign on similarity, which is exactly in line with the model. Last 2 minutes or so, let me give you 2 more slides where I speak to the quantitative importance of selective recall to account for what we actually saw in the data, right? Inflation goes up and does so differently for different cohorts. And then we can also throw another test at the validity of that model. So this slide basically shows you that the anchoring of inflation expectations really needs similarity. So this figure has 2 panels. The left panel is basically the predicted values from our model by different cohorts. And the right panel takes sort of the workhorse model, the Maimonides-Nagel model, and does the same. And you see that from the left panel, state-dependent cues really play an important role for the de-anchoring, especially for the old. So this is the orange line shooting up when inflation becomes more salient. Whereas by contrast, this experience-based learning does really well, as we know, right, in capturing cohort differences. But it doesn't quite, in absolute terms, right, if this is all normalized to 1 in the beginning, capture the magnitude of the changes that we see here. So I think what this says is we need to combine this idea of slow-moving databases with time-varying cues and selective recall to get sort of both the levels and the instability right. And my last slide here to argue for the validity of the model is, we do this nowcasting exercise where we find, again, support for the selective memory model. So what do? We take our basic estimated model up to some point in the middle of 2022 when inflation actually peaked, and then we just put the population constant, right, or the age distribution, and we feed in at each point in time the Q, the inflation Qs, and we can compare the realized with the predicted expectations, and you can see that in our model, that's the solid red line on top. We can sort of get both the de-anchoring and sort of the re-anchoring of inflation, right, in terms of dynamics, while the more conventional experience effect models with a slow-moving database just can't really do that. To conclude in my overtime, I think I try to argue that these laws of recall are highly relevant for belief formation, especially because expectations are not rational, but they're also not mechanically adaptive. There's clearly an interaction of experiences and cues. There are potentially many policy implications. So, for example, policy shapes your memory database, but also realized inflation and any act of communication is also be in memory, right? It's going to be a cue at the same time. So I think there's this rich food for thought.
Thank you very much, Raphael. Our discussant will be Lena Dräger, who will be joining us online.
Hi, thanks for allowing me to do this online really spontaneously. Let me just share my slides quickly. All right. Yeah, that seems to be working great. So yes, thanks to the organizers for asking me to think about this really interesting paper. I will just summarize it very briefly and then talk about my thoughts on it. So as we just heard in Raphael's presentation, what the authors propose is a model with selective memory cues driving the formation of inflation expectations, where expectations depend on the database that in their example depends on age mainly, as well as on cues for recent inflation, and that depend on the period that we're in, as well as current inflation, and the type of forecasting task that people have to do when we measure expectations. And then there's this interaction between the database and the cue, where we have, for instance, primacy effects, where the cue triggers early memories, or recency effects when the cue triggers recent experience, as well as numerical similarity effects when past inflation experience that are close to current inflation are easier to recall. And as Raphael just showed, this can explain some features in survey data of households' inflation expectations, such as the faster increase of older cohorts inflation expectations during the recent inflation surge, and the fact that then younger cohorts caught up quickly and also raised their forecasts. And it can also explain some of the differences that we see between point forecasts and density forecasts. And the authors explain the difference by the fact that the density forecasts remind people of the fact that there can also be deflation, and then this lowest average forecasts. So when I read this model, I thought about the database first. And I think that this is a really relevant part of what we should think about in terms of inflation expectations. And I totally agree that databases differ, of course, across age cohorts. But I think they can also differ according to other characteristics that might be relevant and that could maybe make this an even broader idea to think about. So for instance, education or literacy is, as we know, a really important driver of inflation expectations and affects kind of the personal database in the sense that how well does an individual actually understand what inflation is and is able to then correctly remember it. So even people from the same age cohorts might have different databases in that sense. Another important factor could be the personal inflation rate. So we know that experience inflation can vary across income, education, or age groups because of differences in consumption baskets. So then if you think about a personal database, perhaps we should consider that personal inflation rate as the benchmark and not average official inflation. And finally, perceptions of current aggregate inflation. So we measure these in some surveys, and we typically find that there is a difference between perceived and actual official inflation, and we often see a similar bias in perceptions than we do for expectations. And so if we take those perceptions as the relevant database, we still see similar effects from the model perspective as well as in the data. And just to illustrate this a little bit, I took the University of Michigan survey data and just did some graphs here for the age groups that are in the paper, and then comparing that with education, for instance. And you see that there is a similar pattern when inflation rises. So higher education groups, they increase their expectations faster. But then there's something else that emerges, which I also find interesting in the sense that when inflation then decreases again, so in this disinflation period, there's this large heterogeneity that emerges between the education groups. And perhaps that is because not all of them updated their database to the fact that inflation was going down again. In terms of personal inflation rates, these are calculated personal inflation rates from the ECB consumer expectation survey based on spending shares that people give in the survey, and then the relevant Koikot price indices. And we see here for age as well as income and education groups that there are these differences in terms of experience inflation during the recent search between the groups. So different to what the US data seems to suggest here, older cohorts experienced a stronger inflation surge compared to younger cohorts. And similarly for the low income groups. And then also for education, we see these very striking differences, particularly at the peak. So that also could suggest that kind of the personal experience inflation differs across the same categories for which we find these differences in inflation expectations. And then just aggregating across everything, here we have inflation perceptions, and you see that it matches the perceived inflation rate quite closely during the search, but then people also on average did not perceive the disinflation and instead were more persistent in their inflation perceptions. The next comment I had was about this inconsistency between point and density forecasts. So in principle, I think these results are very plausible. They're also in line with another paper in the literature that shows that when we center the bins around individual point forecasts, that improves the consistency between the two types of forecasts, which goes in exactly the same direction as to the proposal by Raphael and co-authors. But I was wondering about this, two facts actually. So one, that there are these unbounded bins in the upper and lower categories, and then typically there is a number that is given, and then it says, I don't know, 16% or higher, or minus 16 and lower. So there's a numerical Q, but it's still an unbounded bin. And the question I had was how relevant this Q might be for during an inflation search. So usually we would be far away from these numbers, but then there was a period when we weren't that far away. And how that maybe links also to very high inflation point forecasts that we always have in this type of data, which typically get winsorized or truncated because we would think that these are not plausible. But then again, during an inflation search, they become perhaps more plausible. And where would we draw the line there? And what does this imply for this difference between these two types of forecasts? And then maybe related to that, the issue of forecast uncertainty. So typically we say, okay, in a point forecast, we just don't know the level of individual forecast uncertainty around that forecast. But then other authors like Carola Binder, for instance, have suggested that forecasts that are multiples of 5, for instance, point towards high individual forecast uncertainty, in the sense that these people don't really have any idea and they just pick a number that is round. And when we look at density forecasts, of course, we can estimate individual point forecast uncertainty, but that can also be misleading, because if a person puts 100% probability mass in one bin, this looks like she's extremely confident in her forecast, but it could also be that she just doesn't understand how this type of question works, and she's actually very uncertain about her forecast. And then how can we distinguish that from a person that puts the same probability in all the bins, which would also then be recognized as a very uncertain forecast? So I think a robustness check that could account for that to some extent would be by taking the people in these spikes at multiples of 5 that we can see also here in the data that the authors use, and their density forecast as well. Take these out of the equation and then check again what the results tell us. Yeah, and to see it just if we get the same result. And then finally, I was thinking about this selective memory model and rational inattention models that are often used to model kind of inattention, changes between inattention and attention. And so the rational inattention model would say that there is a higher incentive to be better informed about inflation when inflation becomes high and volatile, because then the cost of getting informed is lower than the benefit from being better informed. And that kind of implies a dynamic database in the sense that sometimes I'm attentive, sometimes I'm not, and also a strong kind of imprint of high inflation in that database, because those are the periods when I become better informed. But then, of course, in the rational inattention model, people endogenously choose when to pay attention, because there's always this cost-benefit analysis going on, whereas in this model here, it's more of a psychological mechanism that is more unconscious or happens unconsciously. And so I think it might be really interesting to think about how this could interact or how the two models might be combined, that there is an aspect of conscious endogenous attention and then also these unconscious mechanism ongoing. So yeah, that's it for me in some great paper. Thanks again. And I look forward to seeing you all in person next time.
Thank you, Lena. We'll collect a few questions from the floor. Yeah, no.
Yes, so in some sense, your result is very, and in this room, I can't help making the link, is very consistent with Otmar Issing's view of the credibility of central banks. You know, there's no such thing as a track record. So basically, if you go through a long period of inflation stability at the aggregate level, so you may have this disaggregated differences and heterogeneity in experience because individuals have different baskets. But you know, the longer you go through a period of inflation stability, the more likely it is that people will not pick up, the inflation expectation will not pick up when they experience inflation. So that's basically to a large extent, having had a short-lived inflation cycle after COVID and the Russian invasion of Ukraine, was a dividend of this long stability. But by the same token, now, I mean, are you running, or can you run experiment of, how fast it would take using your model? And, what, for instance, we have this a great natural experiment or natural quote unquote of tariffs. And this is going to increase inflation in the US, with reasonable estimates of how much this would increase. Can you forecast, the disanchoring of inflation expectations that your model would suggest?
Thank you. No, also along the line of showing ignorance on this type of mechanism, but I was wondering, I was struck by the specific functional form that you postulate based on this, cognitive theories. I was wondering, is this an approximation of some more general form, or how robust is this? Is this the only way these distances or the cues from the experience. Is this the only existing theory of this kind of expectations formation in the psychology literature? And perhaps along the lines of what Benoit just mentioned. So how should we use these mechanisms within a model, within a framework that we would normally use in general equilibrium?
Thank you very much for this excellent paper and the really thorough discussion afterwards, Lena. One of the points you made was around the personal experienced inflation rate, because of potentially different consumption bundles that different people have. And I'd just like to add to that, if I may, please, that it may, you can get this even without different consumption bundles, because the personal inflation rates, they also can depend on or be a function of the price point. And this is one thing that we've seen by looking at the micro data set underlying the UK's HICP, where especially for food prices over the recent inflation surge, you saw a compression in that distribution coming from the left, i.e. with cheaper prices, products that started with the cheaper price level exhibiting higher inflation rates than the sort of the more expensive alternatives of those same quick products. Thank you.
One last question. There is one. Raphael?
Yeah, so let me answer these excellent questions and the great discussion. So thank you, Lena. Let me maybe start with the questions, so I might be able to recall more easily. So thanks, Benoit, for this excellent comment. I think I agree. I don't think we'll ever step into the same river twice, right? So it's very interesting to see that's another test of basically this selective recall model right now, right? If inflation goes up more in the UK, the young are not the same as the young that we had before the inflation surge. Well, you can have something similar in the rest of Europe, right? Or when you go down, so I think this is definitely true that you'll get different forecasts in some way. That there's lots of gifts that we have to test our theory right now. And particularly terrorists might be an interesting thing. You can also use potentially the simple nowcasting exercise that we have and just feed in what we have, keep the age structure constant and see what this predicts. And then you get a little bit of a potentially different forecast than we get from other models. I think there's a lot of open questions also, right? So I think we just give sort of some food for thought here. And I think it takes a lot of a central bank perspective to develop this further. So these were excellent questions and suggestions, and I think you can potentially also run experiments to get a better gauge on this. So maybe we can talk more. I think this is really interesting. Now for the other question, I somewhat defer this to the more psychology experts on the team. I think it's also one of my comments for Lena. I think we try to make give a proof of concept that this can work, and this actually goes a long way, like the last two figures show. Certainly, there are different ways to pin down this similarity function, the divergence. I think somewhere in the paper we actually have higher order terms for that. So to think of this some convexity in that. So I think that actually gets even somewhat stronger results. So definitely there's something to explore there. I don't, I think in terms of our more conventional models where we have, in contrast to this, more rational expectations, I think the main call would be to incorporate some behavioral element and see how far that gets us. But I think that's very difficult, and some people in the room have worked on. So I think there's something to do there. as well. We haven't taken that step. And I think that's a little bit related to Lena's comment too, right? There's different measures of time series we can look at in the memory database. You know, it could be perceived, more personal experiences, and so on. I'm totally sympathetic to that. And again, I think we're just trying to prove there's some this addition on the state-dependent element that we introduce through the selective recall that matters, and then you can apply this to any kind of objects you're interested in, any variable. I think this is a rather primitive way to do this. I think it goes surprisingly far. So you can also think about what cues people are looking at. You can encode them. I think there's a lot you can add to this vector. Again, similar to how you specify this divergence function. Now let me move on a little bit to the specific comments that you had, Lena. Thanks for the excellent discussion. Hopefully we can talk in person next time. I'm very sympathetic to everything you've said. For your first comment, you know, I think, apologies if I repeat myself, I think we sort of give a proof of concept that this extra state-dependent element is just important in trying to understand what we have seen, right? Expectations were not sticky, and they were differentially moving, as we also saw from Christiana's work earlier, by different cohorts and kind of other cuts. So there's something there that, you know, we don't explain with our more conventional approaches. Can swap in different elements here, right? Is it perceived inflation, or as I just said? We have some kind of fixed effects in different regressions, controlling for age, education. I think that doesn't speak to this differential speed. I think this is really interesting to explore. At some point, data is also a bit of a limit. You know, for example, like the stuff you showed, the data series you showed from the Michigan survey, right? Like there's very few low education people, right? That's why I see a lot of noise. So I think there'll be some empirical trade-off, but I think central banks like the ECB are collecting really thick data, so we can do a lot of this stuff really well. So thanks for that. Yeah, and I'm very sympathetic to your other comments. The second comment, I think more broadly, I would say, is a call to arms to think a little bit about how we want to design our surveys. You know, what goes in there, what's sort of you want to write a theory, what's the optimal way of elicit these beliefs. I think we don't say much here. We have some robustness in the paper, how we think about this. I think it really is important to think first what we want to use as a design to get at beliefs and sort of then put that in relation. So I think that's what I have to say. I should also say in more normal times, we sort of also get this inconsistency, right, which is sort of emphasizing the key mechanism. So I think this mechanism is really there. And then thanks for your final comment about inattention. I think there's actually some great work by Olli Pfajfar and co-authors where they sort of base the ways according to which we update on inattention, but also they relate this now to experiences. So there's the different layers of how you can see this, and it also gives you this differential dynamics. I think once you have information in any of these inattention models, you're more of a Bayesian person, right? And I think that just points to this new dimension that we add. There's still the selective recall that creates this inconsistency, and you know, as a Bayesian updater, you should be consistent across how you use this information. So I think there's just something else we adding that's important to understand expectations.